Well, the Cedi's good run is still on, and as we speak now, with 10 Cedis, 27 pesos, or 10 Cedis, 30 pesos, you could get the greenback. And don't be surprised, because this has actually been the best round of the Cedi since redenomination. And this afternoon, that's what we are going to analyze. It's not just some numbers dropping, but in terms of government debt servicing obligation, debt to GDP ratio, the debt burden itself, what is really going to happen since we are seeing this kind of sweet movement in terms of where the Cedi has been since the beginning of the year. And President Mahama has actually weighed in, and he's saying that, look, there is some good news for the people of Ghana, and that is our debt position is currently down by some 150 billion Ghana cedis. Not because we are not borrowing, but because the currency is performing well against the American dollar. And so I'm joined by Caleb Ziblim, and we are going to analyze it for you like we always do on Beyond the Numbers. Winston Taki is not on set today. He's elsewhere performing equally important duties. But we are here. We'll break the numbers for you. And Caleb, the president has spoken, and even before he made this revelation, we had projected that there could be some good news coming our way, looking at how the Cedi was performing well against the dollar. As at the time we were doing our projection, $1 was selling around 12 cedis. Now we can talk of 10 cedis, 27 pesos roughly. Exactly. And we were estimating then that Ghana's debt stock, especially looking at it on the external level, could go down by some 74 billion Ghana cedis. That was when we were doing our calculation. Absolutely. The president has spoken, and he is quoting this figure. What do we know? What's behind these numbers, Killer?
So, over 50% of Ghana's total debt is in foreign currency.
Yeah.
External debt.
Very big.
And that's mainly in dollars because that's the world reserve currency at the moment. So if your exchange rate to the dollar, or the Cedi to the dollar, is performing very well, you should know that your external debt is going to take a hit. Your overall public debt will reduce. Because if you borrowed at a time where the dollar was 15 cedis, now the dollar is 10 cedis, you need less dollars now to pay back that $1 you took. So favorable exchange rate is good for the economy because it creates out fiscal space. Now, instead of so many cedis chasing a few dollars, you can keep some of the cedis, use that domestically, then the few dollars we have, we can use that to for service our external debt.
The interesting numbers we are seeing, and I remember when we put our projections out, the next day we had the NPC and the report came out, the data pack, and we saw the debts, burden actually rising to a little, above 700 billion Ghana cedis. And people were questioning our projections and saying that, well, Joy News was projecting that the debt stock was going to come down. Why are we seeing the increment? They should understand that as at the time Bank of Ghana was doing that calculation, it was using the March exchange rate. Yeah. And if you go into that data pack, you could see that March exchange rate was quite high, above $1 to 14 cedis. Yeah. And so definitely, if we increase our external debt stock by, a small unit, you will see that, the debt stock will actually increase over there. But now going into April, May, June, if the Cedi should stay where it is now, we definitely should see some sort of, slashing in terms of the current debt stock. And you were...
And even on that point, more importantly, the figures quoted by the central bank was our debt stock as of March 2025.
Exactly.
Not April
or
May.
When the exchange rate actually started being favorable to us.
So we ended at March 2025. And back then, the dollar to the Cedi was about 1 to 15 cedis, 50 pesos. So that was the exchange rate that the central bank used because that's the debt stock at the time. But then April and May, we've not seen the figures for that yet. And once we see the figures, we're going to see this drop we're talking about. And then we'll fact check whether it's actually 150 billion, but then we'll get there shortly.
But we possibly should. The president said 150, right? maybe we could actually get more.
Depending on how
the exchange rate performs.
200 billion probably.
Yeah, but it's the mountain that we've all been complaining about, the mountain of debt stock we've seen as a country.
Yeah.
And it got to a point somewhere, September of 2024, our debt stock actually crossed 800 billion, Ghana cedis, and it was a huge burden. And if you look at some of the stories behind this, the backstories we had going into our 17th IMF program, and why we even struggled to get a program, why some investors had to take haircuts, it was because of the rise in debt stock. And that actually brought down the confidence in the Ghanaian economy. Now, if you have your debt to GDP ratio, which obviously thanks to the performance of the cedi going to, come down, your debt obligation also going to come down, then it simply means that we can now understand why confidence in the Ghanaian economy is so high at the moment. And we will be analyzing whether we've been able to overcome that debt distress status that the IMF gave. This is the mountain we've seen so far. What's the outlook going for it, Caleb?
So currently we are locked out of the external market. And even domestically, we have just the treasury markets. We've not gone back to the bond market yet. So looking at our debt figures, we should not see them rise too much because we cannot get funding from outside the country, except with the bilateral partners, the IMF and the World Bank. Aside that, and then maybe some other concessionary loans there and there, we are not getting loans from anybody else. So at this moment, it's our domestic debts that should be rising. And even if you look at the data from the central bank, our domestic debt is not really rising. And you can also point to the treasury markets where interest rates are very low, pre-COVID levels, and the finance ministry is actually rejecting so many bits, even though it's below the target that they want to meet for that treasury bill window. So our domestic debt is not rising per se, and external debt is plateauing because we're not getting funding from anyone else. That's good.
That's some sort of good news, right?
That's very good news because, we are in this problem because our debt was too much. So we have to control our debt. And that's why we are, one of the reasons why we are in this IMF program is to control our debts and then send signals to the external markets that we now have control of our finances before we can now start looking outward. And the president hinted that we might go back to the bond market very soon.
Well, the most important thing we always do here is to tell you the stories behind the numbers. And of course, the inside story we are getting, trying to understand what is really going on in the minds and heads of, the finance minister and the governor. And we understand that, look, they really want a country with a very, sustainable debt, portfolio in terms of the outlook. And one of the ways they are using to actually remove that debt distress status is to drive down the exchange rate, where, when you're able to get a certain level, you can now assess your debt and say, okay, at this point, we think that our debt servicing, our debt obligation, our debt outlook is sustainable. So many have said that until government drives or until government achieve that, best outlook, which is not at the same as debt distress, they will continue to drive down the exchange rate. Why? Because government wants to look good in the eyes of the international creditors. We've heard the president, he started talking about going back to the international capital market, a conversation we will definitely have on Friday as to whether Ghana is actually ripe for the international capital market and when should we even enter the market. But the president is actually preparing the minds of investors that, look, get ready, we may be coming your way very soon. But of course, many have said that this was an economy that its currency was being backed by Eurobonds and definitely loans, right? And looking at, the data we are analyzing, we are seeing the shift where now the kind of stability we are seeing in the cedi is not from loans, right? It's not from Eurobonds, but rather from our gold reserves, from the purchase of gold, cocoa, remittances, and what have you. And that's the reason why we are at this point today. So, at what point should government say that, look, enough is enough? Maybe we've reached at, we've been able to remove that debt distress tag. Do you think that we can actually get there anytime soon? And what's the possible way to actually get there, Caleb?
Well, I'll start on the second question, the possible way to get there. And For the past few months, we can see some coordination between the fiscal and the monetary authorities. Because in order to now say you're going back into the local bond market for long-term security, you need to drive down the exchange rates. Because if treasury bills are going at 28%, your bond markets must reflect that. And if you're struggling with your debts, as we are already, you cannot afford to be paying bonds as high as 20, 30%, which means the rates on bonds will have to come down, which is why we are seeing this reduction in the treasury bill rates. Once the treasury bill rates go down and below what's favorable for investors, they'll start looking elsewhere. And now the dollar is also going down. So you can't go and pack your money in dollars and expect that
anymore.
Exactly. I expect that in a month or two, you're going to get interest on that, because right now the dollar is tumbling against the cedi. So the T-bill market is off. The dollar exchange is also another contributing factor. So now investors need somewhere else to park their cash.
Yeah.
And then gold prices too are going up, but because of the exchange rates, you're not going to see that significant revenue you're going to get if you invest in gold again.
So now where do you go?
If the government comes back with favorable terms in the bond markets, I think people will look at that favorably.
That's actually a very good matrix, and I love the analysis you're putting out there that government, of course, is trying to make holding of dollars less, lucrative. Don't go to the treasury bill market because we have less to offer you in terms of coupon.
Exactly.
Wait for us. We are about to, come your way with new bonds. Come into that market and possibly. Now it is more, profitable to hold CDs than dollars. So if definitely government comes and then starts giving out new bonds with even interest as high as 18 or 19% or 20%, investors will rush in there. And we were doing the analysis backstage, and I was actually, thinking about this whole paradox and said that this whole exchange rate simply means that now it is now expensive to even have debt in cedis. And it's cheaper to hold debt in dollars, right? So with the conversation and the precedent preparing the minds of investors that will be coming your way very soon, it means that should government succeed in meeting demand with supply in terms of the forex, right, and driving down the exchange rates, this could be a good advantage for them to enter the capital market, because the fear was that if you enter the capital market, any dollar you get was going to be priced at 15 cedis or 16 cedis. Plus its interest is going to have some toll on the government in terms of repayment. So if you really want to go into the capital market within the shortest possible time, the one thing you need to do is to push down the exchange rate so that getting the forex in the international capital market will be cheaper. And when you're able to get the dollars into the space, it will rather come in to help the cedi, to help keep the cedi afloat, and then also make sure that some of your fundamentals are actually really working well. And so the matrix is really, really, very interesting dynamics we are seeing, and how government is actually playing this game. It's definitely now going their way. But in the long term, what do you actually see?
And well, in the long term, it's about stability. Because if the exchange rate is favorable now and quite stable, and it looks good now. But then if next year you cannot keep the stability, next year the exchange rate goes up again or goes back to the 15, from 10 to 15, it's detrimental. Because investors will now start looking towards...
You lose confidence.
Exactly.
Right?
Confidence and everything goes down. So it's about keeping this momentum we are seeing. And also we know that majority of this is on the back of gold and also on the US trade policies and all of that. So we cannot rely on that because these are commodity prices. Gold and cocoa. We cannot keep relying on these things because the prices are volatile. They can come up, they can go down. So there needs to be a sort of buffer in place, which is why we are seeing 4.7 months of import cover at the moment. Even though the minimum should be 3 months, I think we should go as high as 7 months, if we can. Because we need that buffer in place to ensure that confidence remains throughout. Once you lose confidence, that's it. And the same with inflation. Once people expect that prices are going to go up the next month, no matter what you do, it won't work. Everyone just keeps increasing prices because they expect it to go up. So we need to increase prices. So I think moving forward, it's just about confidence in the economy. And we've seen the business consumer confidence, the business and consumer confidence index has been going up to all-time highs. Before, the highest was in 2018, thereabout. Now we are at more than 100.
102, right?
102, 103, which is good. But then again, keeping this momentum. And then I think on Friday we'll delve deeper into that. So I think that my point is the momentum. We have to keep this up, stability and momentum.
Now, keeping momentum, definitely you would want to remove the debt distress status.
Yeah.
And per the data we are looking at, government is almost there. I mean, Ghana will be declared stable again, and our debt levels will no longer be at that distress level, where even we're trying to look at the IMF risk matrix and then risk indicators. And if you come to the domestic space, they were actually looking at some of the domestic factors like the 2024 elections, and they have said that spillovers could affect, the program. And IMF was even projecting that there's going to be a lot of pressure on the exchange rate, right? A lot of pressure on even revenue and so many things. But it looks like what the IMF projected versus what we are seeing now, big contrast, where, the Ghanaian economy has been able to overturn that kind of doom that was placed on it in terms of looking at the outlook in that 2024 IMF report, December report. Now, we can see a very clear path in terms of where the government wants to go. Definitely, you are looking at the distress status and your debt to GDP ratio at the moment. The projection was that we should be at a certain point by 2028. Per what you have seen so far, do you think that we are going to achieve this even way before the target year 2028, Caleb?
Well, the projection from the IMF was that by the end of next year, we'll have a debt to GDP of around 67%.
Yeah.
Now we are seeing 55%. Mm-hmm. So
it could go down, right?
It could go down, but then again, it could go up.
Yeah.
Depending on how we look at re-entering the bond market again. So right now, we've met a target, but then there's still a long way to go. There's about a year to go before we exit the IMF program. So if we don't approach the bond market very well and strategically, we might keep adding to our debts. We might then again increase our debt to GDP ratio. But at the moment, we seem to have met the target.
Yeah.
But then it depends, like I said, it depends on how we are going to be adding more debts moving forward, especially in the domestic side, because the domestic side as well, that's where government is getting the revenue, the additional revenue to support its budget now. But then again, you're also seeing a very, I don't know the word to use, but a very tight fiscal policy at the moment, which means that
very tight.
Very tight.
Discipline, right?
Very tight and discipline. So if we can maintain this, I believe we should make this target very easy.
Well, this is the stubborn side of the whole debt equation, and if you could break this down for us, I will be very happy, and our viewers will also be very happy.
So when we are talking about our debt and then how the cedi can benefit Ghana's total debt, it's mainly on our external debt, because our domestic debt, we borrow in cedis.
Yeah.
The exchange rate has no effects on that. But then with the external debt, we borrow mainly in dollars, because that's the reserve currency. So once the exchange rate is high, it means that you're going to pay more, you need more cedis to pay back your debt. And this is very interesting. If you look at the red line is our debt, our external debt in dollars. Mm-hmm. And the black line is our external debt in cedis. Now, so from 2024, last year, March, to March 2025, the line is almost straight.
So almost like a horizontal line.
Exactly. Even though it has shifted up a bit, it's almost straight. Last year, we started at, last year, March, it was $31.1 billion. Mm-hmm. And then we ended the year around $28 billion. We are currently at 28.5 billion.
I think after the restructuring, we were able to get some haircut.
Exactly.
We came to 28, right?
Yeah. So as you can see, from 31 to 28, almost a very straight line. Just a few $1 billion has left. But if you look at our debt in cedis, we need the cedis to pay back the dollars.
To go and buy the dollars.
Exactly. So if you look at it, even though the line is straight, especially from March 2024 to August 2024, our debt didn't change. It was $31.1 billion, a straight line. But then you can see the same period from March 2024 to September 2024, as debt in cedis has been rising. From $400 billion to 400 billion cedis to 508 billion cedis. So you can see that even though our debt in our external debt does not change, how much we needed to pay that increase, and that was mainly because of the exchange rate. It's because of the exchange rate.
Yeah.
And if you look at the exchange rate graph from last year, you can see that from March to September, it was rising. It started dropping after September, closer to the election, after it peaked at 16 to around 14% at the end of last year, which again, you can see from this trend.
You can see from this side.
Exactly.
Right?
Even though our debt dropped a bit, it was mainly because the exchange rate became favorable. And then again, you can see that after the election last year and January this year, our exchange rate was 14.7 at the beginning of this year. And then it went up to 15.5, where it stayed at 15.5
For a while.
And then again, you can see it playing out here. So after rising last year, it peaked, dropped, and then earlier this year, it was stable. So the exchange rate plays a major part in how much we need to pay our external debt.
So in simple terms, this is what I picked from what you just said. This is actually how much we owe.
Yes.
And if you want to really understand this, Caleb has actually done a fantastic job. But this is how much we owe, red line in dollar terms, how much we owe. And in the blue line for me, I will not call it debt, but I'll call it how much we need to pay.
Exactly.
You said it, and I want to emphasize on that. Red is how much you owe, almost stable. We don't really add a lot.
Because we are locked out of the market.
Exactly. If we're still borrowing from the Eurobond market, would have seen a spike or would have seen it increasing. And also there's a cap that has been placed on us by the IMF where we cannot borrow more than a certain amount. But this is how much we need to service the debt. How much CDs we need to service these debts. And you can see that anytime the dollar gains, the CD gains against the dollar, that amount we need comes down. And anytime, the CD loses against the dollar, what you see is that the amount we need goes up. And that was what Caleb was explaining. Now, this is the same, the president is not a magician. He's been doing the math himself. And this is what he was making mention, he made mention yesterday. What the president said, he used numbers to actually determine that 150 billion he actually quoted. Yeah. So Caleb, just look at this. If we're still at $1 to 15 cedis, 54 pesos, 52 pesos, our debt of $28.5 billion would have required 442.5 billion cedis to pay that.
Exactly.
So just look at it, almost $29 billion. And look at how much you need in cedis to pay. Almost 443 billion, cedis to pay back.
And that was as of March 2025.
That was as of March 2025, and we're using this exchange.
Exactly.
Now, the cedi has done its miracle, and we are seeing, this sweet movement continue. Let's see how that is playing out, Caleb.
Yeah. So, if you look at how the cedi is doing now, we need roughly 10 cedis, 30 pesos, but I just took it to 10 cedis, 50 pesos.
Yeah, 50 pesos, yeah.
For argument's sake.
Yeah.
If you brought it down to 10 cedis, 20 pesos, this would have been much lower.
Yeah.
But then 10 cedis, 50 pesos to $1. When you do that, you get 299.
That's a big slash. Just look at this. With 15 cedis, 52 pesos, you needed 443 billion cedis to pay back.
Yeah.
Now with $1 to 10 cedis, 50 pesos, well, if you are trying to be very diplomatic, right?
Exactly.
You need almost less than half, right? 299 point, let's say 300 billion cedis to pay back.
Yeah.
That is a big saving. And that was the math that the president was doing. And let's see how he got his figure. The president quoted
about
150 billion, right? And we even used 10 cedis, 50 pesos. And I'm sure somebody had whispered into the president's ears that, Mr. President, it could go down to 10 cedis,
Exactly.
So if you use 10 cedis, you could be hovering around that 150 billion the president mentioned.
Exactly.
But if we are using the prevailing rate right now and trying to do the midpoint rate, what we were able to calculate is 143.25, almost 144 billion cedis.
Yeah.
Gone, freed up, savings. Like, just imagine 144 billion Ghana cedis wiped out. It's gone, slashed away. Like you will not pay it.
And the interesting is that the thing about the debt payments is that you need revenue to go and find these dollars.
Exactly.
So this is government revenue that has been saved.
Yes, government revenues, exactly. Saved, because we'll be talking about debt servicing very soon.
Exactly.
And you made mention of government revenue saved. Now, for me, the reason why this is a big relief is that no amount of debt restructuring can actually save you this amount.
Exactly.
Because the entire debt restructuring we did in the domestic space, we saved about 68 billion cedis, right? and then we added the external. So it means that in the year that we were doing the debt restructuring, if we had policies to drive down the cedi, there was no need for us to do debt restructuring.
Exactly.
If we were able to drive down the cedi from where it went 16 cedis to about 9 cedis, government wouldn't have been required to do debt servicing obligation because we could have paid. We couldn't pay because we needed more cedis to buy fewer dollars to pay our debt.
Exactly.
And so this, for me, it's an indirect debt restructuring, that positive one, let me put it that way, where the haircut is not on anybody's head, but rather the haircut has actually saved government some 144 billion Ghana cedis. And you were talking about debt servicing.
Yes, because we need our revenue to pay back. But then the interesting thing I was going to point out was that this is at 10 cedis, 50 pesos. And with the momentum we are seeing, the cedi might keep performing better against the dollar.
Yeah.
Which means if we are able to keep this up and then support our forex inflows and all of that, and we get to, let's say, 10 cedis, or even if we are very optimistic,
8 cedis, 50 pesos.
I'm afraid to go to 8 cedis, but let's say 9 cedis, 10 cedis. We are going to be saving more than this.
That's big. That's big. It could actually hit 200 billion Ghana cedis very soon.
Yeah. And if you do the math, that's about shaving 18% off our total debt.
This is the biggest haircut I've ever seen, but this haircut brings no form of pain to any investor.
Exactly. We all laughing about it.
Yeah, I mean, if you're an investor and decided to keep dollars, that's a big haircut for you. That one
then you shouldn't keep dollars
do
because you're in Ghana, right?
Yes, you can't keep dollars. I mean, but for us, this could save government a lot. Where even with the target of the IMF, I mean, by this year we should hit that target. Yeah, absolutely. That 2028 that IMF was looking at, we have actually seen that success. And for us, what you should take away from this program is that without any form of debt restructuring, government has been able to save some 150 billion Ghana cedis just because it was able to drive down the exchange rate to its natural level. I mean, of course, we'll be doing more on Friday. The president has been calling for Ghana to start the issuance of Eurobond. We'll be asking ourselves, how soon is soon? This has been Beyond the Numbers with me, Isaac Okofie, and I did this with
Caleb Ziblim.
Winston Taki will join us Friday, but for now he's enjoying somewhere. But know that big savings for government, and this is big. We keep watching. The city keeps performing, and I don't want to do any form of projection, but I mean, we all have the Excel sheet, and everybody has been turned to an economist. We are all watching the market, see where we'll be. But definitely where we want to be. Everybody is projecting single digits, but the question is when and how significant will it be in terms of removing that debt distress status from Ghana. But per what we've analyzed, that debt distress status will no longer be there because of the kind of savings we are doing now. Thank you very much for watching. Stay tuned. This has been Beyond the Numbers. Let's go and get some.